Hello, this is Ariane Chapelle on behalf of Elsewhere Company. Today, I'm going to present how the design of scenarios for operational risk can help bridging the gap between risk quantification and risk management by identifying key drivers of the operational risk capital. We all know that operational risk matters. Recent news shows that for 2014 only, several institutions suffered very significant operational losses. These events had a major impact on the company management and organization, as for instance, the president of BNP Paribas left the bank as a direct consequence of the large fine they have to find in the US. The definition of operational risk is very broad. The processes generating operational losses are extremely diverse, and losses can have their origin in a single person, as in internal fraud, in the whole company practices, in the external human event or natural event. Basel III and Solvency II require to hold enough capital to be able to face any event or combination or event with joint probability higher than a certain threshold, 1 in 1,000 for Basel III, 1 in 200 for Solvency II. However, there are several benefits in trying to build an internal model of operation risk. As we will see, working in the detail of major risk scenarios will bring a better understanding of exposures, weaknesses, and will eventually help reducing the risks. Having said that, modeling operational risk is very challenging. One approach is modeling from loss data, and it is a purely statistical view, but therefore can miss some major potential event. Indeed, scenario data can be found in external database, but these originate from different contexts, different processes, different scales. Using in-house expert assessment to evaluate scenarios can be very hazardous, as we will see. An alternative is a scenario-driven approach. In this case, you try to analyze the drivers and potential outcome of all scenarios, but you need to have a common structure, a common methodology for this. You also need to be reasonably sure that you have identified most of the scenarios relevant to your activity. Finally, you need to assess their interdependencies. This is the most significant benefit, although the first incentive to initiate an internal model project is the reduction in regulatory capital. This requirement is indeed very challenging, as it implies assessing the probability and potential impact range of each event together with their dependencies. Given that most of the potential major events are rare and depending on the organization, it is very difficult to use internal or external statistical data to perform this assessment. In recent paper, the BIS has presented two main lessons learned from the implementation of internal model with AMA banks. Firstly, the scenarios represent a major part of the capital charge, at least in Europe. Although the pattern might be different in the US, globally, scenarios are the main drivers of capital. This sounds reasonable, as regulatory capital is precisely used for hedging major unexpected events. But, and this is a key finding of the BIS survey, the assessment of scenarios remain very uncertain, as it is usually performed by the experts. Secondly, the use of business environment and internal control factors are generally an indirect ex-post adjustment to capital number. This is not good enough, since BEICF are one of the mandatory input of the model and represent the influence of risk management onto the level of capital of a firm with regards to operational risk. Now, let's discuss two approaches we would like to differentiate when it comes to modeling operational risk. The data point of view, or data-driven approach, considers internal losses, external losses, and scenario as data points that can inform the distribution of losses. In using these loss distribution approach, all information are scaled to fit a distribution of potential losses. This picture shows very simply the findings of the BIS survey. Since the scenarios are usually the largest event considered, an uncertainty in their assessment would impact directly the distribution. And of course, the BEICF cannot be used directly in that framework as they cannot be used as data points. Therefore, they are often ex post adjustment, either to scale some losses or more often to select the shape of the distribution. In the scenario modeling approach that we call the model approach, the perspective is completely different. Internal losses and external losses are used in complement to the risk register or RCSA to identify major scenarios. For each of these scenarios, a specific model is created. This model is designed and quantified using business knowledge and data and produces a distribution of potential losses. Now we see the difference. Of course, there's an uncertainty in the assessment of scenarios, but this uncertainty is modeled and represented in a distribution. This implies that the uncertainty around scenario assessment is now part of the risk model rather than a source of instability in the inferred distribution. This simplified methodology behind a model-based approach is simple. The first step is identification of plausible adverse operational risk scenario from the risk register of RCSA. The risk register itself should be informed by internal and external losses. The second step is expert assessment. Scenario owners assess the scenario's frequency, range of impact, and major drivers of the scenarios, i.e., the factors that can influence the probability or severity of the scenario. The third step is structured assessment. A Bayesian network model is created per scenario based on the exposure, occurrence, and impact of the scenario. This model is then quantified. The fourth step is aggregation. By assessing the dependencies between scenarios through a set of common drivers, an aggregate distribution is produced. Now we will focus on the structured assessment step of scenarios. Here we show, in a simplified way of course, how a simple scenario narrative can be interpreted to identify the key drivers of a scenario. The exposure at risk for a fraud scenario is linked to the number of people in position to perpetrate the fraud, either employees or contractors. The probability and severity of the fraud are linked to the hierarchical level of the employee, knowing from external studies that executive frauds occur less often but with a higher impact. The fraud amount is linked to two factors. What is, for the activity in question, the average amount of a transaction that would remain under the radar, and how successful is the fraudster going to be in issuing several of these transactions. For instance, for a fraudster issuing a fake mortgage application, he or she would typically use an amount in the order of magnitude of a typical loan, say £100,000 to £150,000. Issuing a fake loan with a much higher value would raise attention, and issuing a loan of £20,000 would not be worth the risk. This analysis of the narrative can then be turned into a model. All the scenario models share the same structure around three nodes: exposure, occurrence, and impact. Considering that a scenario is the encounter of a resource and an event, exposure is the number of resources exposed to the event, occurrence is defined by the probability that one particular resource is hit by the considered event, impact is the cost of the event occurring for one resource. Exposure, occurrence, and impact depend on other variables, which of course are scenario specific. In this example, exposure is the number of employees and contractors in position to perpetrate the fraud. The probability of occurrence depends on the scenario level of the person at risk and is assessed using a low, medium, high assumption. The impact is expressed as the product of three variables: the typical amount of the activity at risk, for instance, the average amount of a mortgage loan, the intensity, i.e. the number of fraudulent transactions that can be issued before detection, and finally, a variable linked to the seniority level that will express the fact that a fraud from a senior executive will generally have a higher impact. Once the structure of the model has been established, each node of the model needs to be quantified. We can see here that all the nodes show a warning, indicating that they need a quantified input. Data for quantification can come from different sources. Observable business data. Here, the number of clerks, managers, and executives in position to perpetrate a fraud can easily be obtained from the business. Loss database. The probability of fraud per individual can be estimated throughout the organization using actual cases. It can also be assessed from external sources. Expert assessment. The intensity of the fraud, i.e. the number of fraudulent transactions can be issued before the fraudster gets caught, is typically assessed by expert opinion. All nodes can and should be quantified using a range of values to express the uncertainty of the assessment. As we will see, these ranges will be combined to assess the distribution of losses through Monte Carlo simulations. It works very simply. In a few words, it's about combining all uncertainties around assessment to create a distribution of losses resulting from a scenario. A simulation run is carried out as follows. First, we sample the number of exposed objects. Remember that risk is calculated for the future, so even the number of employees need to be assessed with some uncertainty around it. This would be even clearer if the exposure would be, for instance, a number of transactions for a trading error scenario. Once the number of exposed objects have been sampled for each of them, we sample the occurrence. In that case, it would mean, will this person perpetrate a fraud? Given the low probability of fraud, the answer will most probably be no. But in some case, for instance, 1 case in 1,000, the answer would be yes. And then we need to sample the impact. For this, we need to sample all the variables conditioning the impact, and in particular, the intensity node. Each simulation run will come out with no loss, one, or several losses. Running this 1 million times and arranging the outcomes will produce a distribution. This is the distribution of the scenario cost that we see on the graph here. We can now start to imagine how such a model can be linked to risk management. In that simple example, just imagine we reduce the exposure. Imagine that the people at risk are people having access to sensitive data, and that the bank or the insurance company would reduce the number of people having access to this data. This would be done by better managing the access rights at the cost of a new project. What would be the impact on this risk? We can create a what-if analysis to assess the impact. You can see here that this is done simply by creating a new hypothesis node conditioning the number of employees exposed. We assume here that the number of employees can be reduced from 1,000 on average to 300 on average. And now we run the simulation again, comparing the two hypotheses. You can see that the risk has significantly decreased by reducing the exposure. The expected loss has decreased from 2.3 million euros to 0.7 million euros. This alone could justify implementing an improved access management program. Even more interestingly, the extreme risk is reduced from 22 million euros to 15 million euros. Now we can start to imagine how a set of models like this could be used to prioritize risk management actions, taking into account the major exposure and the risk appetite of the firm. Now that we have seen in detail a simple example, let's take a quick look at some other scenarios. This example is about mis-selling of insurance product. The exposure at risk is the set of product of a company, such as mobile phone, insurance, legal insurance. For each product, the experts assess the probability of a class action in the near future. The business analysts provide the number of customers for each product. The proportion of clients at risk of mis-selling is assessed, taking into account the distribution channel. The impact is calculated as the sum of customer compensation and regulatory fines, considering a possible extended liability for products sold through partners. Here is an example of a pandemic scenario factoring in the latest information provided by health authorities on the occurrence side and the sensitivity of revenues to temporarily reduced human resources on the impact side. This simple data theft scenario will help us illustrating how data from different sources can be incorporated into the model. The scenario modeled here is an employee compromising sensitive data, credit card data, life insurance policy data, and so on, and sell this information to a criminal network. The exposure is again the number of people having access to sensitive data. The probability of occurrence is the probability that an employee would compromise the data he or she has access to. The impact is the sum of the cost of compromise and the cost of fraud. The cost of compromise is the cost generated simply by the fact that a large amount of client data has been compromised. It involves customer compensation, cost of investigation, cost of consultant to fix the breaches, etc. The cost of fraud is the cost of records effectively used fraudulently. This would of course depend on the capacity of the criminal network to actually use the compromised data before detection. Fortunately, most recent cases have shown that the number of records used fraudulently is very low compared to the number of compromised records. The IT department will provide the number of employees having access to sensitive data and the type of data they have access to. Internal fraud data can be used to assess the probability of one employee compromising sensitive data, even if no internal data compromise has ever been observed within the company. Assuming that the probability of fraud is a behavioral constant, we can use the number of fraud events in the company to infer a general probability of fraud per individual. Of course, this assumption may be combined with external data or expert opinion. The cost per compromised record can be assessed from external reports, such as the one produced yearly by the Ponemon Institute. For the cost per record used fraudulently, and even if no internal data compromise has been observed in the company, it is likely that some fraud of sensitive data has already occurred with an observed range of cost per record. We can use this observed range and combine it by the number of records used fraudulently to infer a range of the total cost of fraud. To assess the number of records used fraudulently, we can rely on external data, past cases, size of criminal networks, etc. This information can be obtained from external sources such as Interpol. The approach we have just discussed is now used routinely in major banks and insurance companies in continental Europe, UK and North America. It has been approved as an official AMA approach by a European regulator. The benefits of this approach are first to improve the quality of assessment. Instead of asking experts to assess the overall cost of a scenario, the decomposition into several components makes the take much easier. Indeed, we ask experts to assess only what they can really evaluate. This helps also mitigating assessment bias. Experts prompt to assess directly a scenario would generally over or underestimate the risk, depending on their position or point of view. Here, it's more difficult to predict the outcome of a simulation. Considering also the fact that we combine several experts and several sources of knowledge, the biases are averaged. As we have seen, this model can leverage on observed data and expert judgment, on internal data and external data, business data and loss data. The assessment is more consistent than a purely data-driven approach. The approach is forward-looking and past losses can be ignored if no longer relevant. Once the model is built, the quantification will be done consistently from year to year. If a model is quantified separately in several countries or business units, this can help sharing and leveraging knowledge and experience. Finally, our experience is that the mere process of designing and quantifying the model will improve risk management, as some weaknesses will be identified and fixed during the process. Here is a simple example of the benefits of the approach. On one hand, A panel of business and IT experts agree on a range of $1 to $10 million for an IT outage. On the other hand, the same panel of experts has decomposed the cost into products of three components: the duration of the outage from 1 to 2 days according to the IT experts, the daily turnover 20 to 50 million according to business experts, the fraction of revenues impacted by an IT outage 5 to 10% considering the current mix of distribution channels. Of course, the resulting range is the same, 1 to 10 million. But even in this very simple example, we can see the benefit of an analytic approach. Experts contribute only in their domain of expertise. Part of the assessment are actual data, turnover for instance, and part are expert judgment, such as the duration of outage, the fraction of revenue impacted. The model is forward-looking. Turnover and fractions impacted should be considered for the future. The assessment can be revised using mitigation actions such as investing in better backup system to reduce the time needed to switch back to normal. The typical question before using this type of model is it resource intensive? You can see that these models are in reality a progressive refinement of widely used frequency and severity assessment. Frequency is here decomposed into exposure and occurrence, and severity is mapped to impact. Exposure is defined as the set of critical applications, and impact can be decomposed into duration, turnover, and impacted business. This could be decomposed further, considering that the probability of outage depends on the application and on its load, which is also linked to the turnover. You decide when the decomposition stops, and it usually stops when the nodes become too qualitative and impossible to assess. So you are in control of the model complexity. In addition, this method gives you a structure in the assessment. In the long run, this is less resource consuming than redoing the assessment from scratch every year. The methodology exposed here has been described in detail in a book referenced in the documentation attached. It is now supported by a tool called MSTAR, which is used by several banks in continental Europe, UK and North America to assess their scenarios and even calculate their regulatory capital. The model has been approved as a valid AMA model by a European regulator. You will find additional information and material available on Elsewhere's website. Thank you very much for your attention.